Oliver, the stereotype of a private equity financed business is that you take it off the stock market, load it up with debt, strip lots of costs out, and then dump it back on the stock market. Some people would say that's a valid description of the AA, the Venerable Automobile Association. Is this a fair description?
I think so, yes. Private equity firms in one form or another own the AA for about a decade. It floated last year and still it's got net debt of about 7 times its EBITDA. That's enormous. Most public companies kind of totter along on 2 or 3 times. The AA is an awful lot more than that. Now, it has to be said the AA is a nicely cash generative business, which I suppose is why private equity liked it in the first place. A lot of people pay their annual memberships, all the fees come in, and there's a lot of cash generation once the cost of attending those members has been paid out. But nevertheless, it's still a very large amount of debt that the business is carrying.
Now, with interest rates so low, there's probably never been a better time to refinance that kind of debt burden. Presumably, that's exactly what the company's doing, is it?
Yeah, that's what the management team who are in now have been doing over the past year or so, particularly this year. They refinanced a lot. Now, the refinancing didn't bring the entire debt piled down by very much, but what it did do was get rid of some of the more expensive parts of it. So some of the notes were paying 9.5% interest, which is an awful lot. What it means is the annual interest bill will fall from just over £200 million to just under 150. So there's a big saving in interest from the refinancing, and that's nicely covered by annual earnings, about 3 times.
And what about the underlying business? I mean, the time was when basically breakdown cover was provided by either the AA or its great rival, the RAC. Now there's a lot more competition. What does that business look like on a sort of longer term basis?
Well, it's still there and still nicely cash generative, but it's not altogether smooth. The main sort of roadside assistance business has been losing customers. That's because the AA used to give out free memberships alongside insurance policies. It doesn't do that anymore. So a lot of the people who used to get free membership and are now being asked to pay are sort of falling off. So customer numbers are declining. And some of the other parts of the business, the insurance and that kind of thing, they're not doing too well either. There's lots of kind of ups and downs. It's not a smoothly growing business, certainly.
So with all that debt and a slightly mixed outlook for the underlying business, how have the shares done since flotation?
Not too badly. They rose in the months after flotation. They've declined a bit more recently, but they're still comfortably ahead of the FTSE All-Share over that period. But what's a little confusing to me is the question of the dividend. This perhaps is what's attracting some people in. At the first half results today, the company has declared that it's going to pay a dividend.
Even though it's got all that debt?
Even though it's got all that debt and the mixed trading outlook, it's still paying a dividend. To me, that looks premature.
Oliver, thanks very much.